Hello and welcome. My name is Dennis Doss. This is the Mortgage and Real Estate Pooling 2013 update. Before I begin my brief presentation, let me say a few words about myself and my law firm, Doss Law. First of all, I'm a lawyer. I've been a lawyer since 1978. Doss Law specializes in real estate finance and has since its inception. But real estate finance means we represent mortgage companies and real estate developers in their real estate projects, both financing and developing real estate. We are one of the largest creators of mortgage pools of any law firm in California, if not the United States. Some of these are quite small, just a few hundred thousands of dollars. Others have grown to well over $100 million. So let's begin. Okay, here is my contact information. My objective today is to review popular mortgage and real estate pool structures. What is a pool? Good question. Typically, it is a limited liability company or a limited partnership formed by a real estate professional at its helm. The real estate professional typically serves as the manager of the entity and enlists the money from private investors to invest into the pool. The manager also is the person that's most active in going out and procuring new mortgages or new real estate opportunities. The manager doesn't operate in a vacuum. Before the entity is started and the pool begins operations, the manager prepares a very detailed prospectus or private placement memorandum which describes the rules of the game, so to speak. What are going to be the parameters of the mortgages we're going to make or the real estate we're going to buy? What is our investment horizon? How are we going to do this? How am I going to be paid? What are the risk factors and the like? Don't attempt that by yourself. You need a lawyer to draft that type of disclosure to protect yourself. But it doesn't. My point is that although the pool is blind in the sense that it doesn't start with a collection of assets, it does collect and accumulate assets pursuant to a very finite and fixed set of rules that are agreed upon between the manager and the investors in advance. Now, why a pool? Why would you create a pool versus buying a single piece of real estate or making a single mortgage? Well, the number one reason is diversification. Investing 101 says you should diversify your risk by spreading your investments over multiple assets. A pool does that. The pool itself holds the mortgages, holds the real estate rentals, for instance, and therefore if any one of those were to not perform as expected, that it doesn't ruin the investment entirely. The pool judges the performance of the investment by the totality of all of the assets within the pool rather than any one particular asset. Now, another reason for a pool is the lack of downtime. When you are investing in a piece of real estate, there's a beginning point and an end point, and in between that is downtime. When you're making a mortgage, you make the mortgage, it pays off, you sit on your money, basically getting nothing at the bank until the next opportunity comes along. Another reason for a pool today in California, for those of you who are in our state and operate under a California real estate broker's license, is we have a law called SB 978 that went into effect this year, which contains all type of restrictions on construction lending, where investors, it affects those people who arrange loans or make loans, where they fractionalize that loan out to multiple lenders and there is direct ownership of the loan. If you create a pool and it gets a license, it is exempt from a CFL license, I should say. It is exempt from the Department of Real Estate construction lending restrictions. Noteworthy among those restrictions are, number one, the broker or the promoter has to separate himself from the construction activity, have a third party both do the inspections as well as handle the disbursement of construction funds. Another somewhat uncompetitive restriction is that the real estate broker or the promoter of the pool must raise 100% of the money on the front end and charge the borrower for 100% of the construction funds up front, which makes them very uncompetitive compared to someone who can incrementally fund and incrementally charge the borrower. Lastly, under this new SB 1978, there's a restriction on the size of loans. You cannot make construction loans over $2.5 million. There's more to it, but that's just one reason why a pool that operates with a CFL license is a good way to avoid these restrictions and still be competitive as a construction lender. And we're seeing that activity pick up a lot, in particular our state. Now, let's look at what has been traditionally done in the way of a mortgage pool. And I made this pie here. This pie represents the entire cash flow on a mortgage transaction in this case. The income comes from origination, that's points and fees that are generated when the loan is made, and also the interest income that comes in to the fund. Those are the two sources of money. There could be some profit on the sale of foreclosed mortgages, but we don't really go into these pools with the idea of foreclosing and profiting from foreclosure. So the two sources of income, origination income and interest income. This pie chart here represents how that is divided. The blue represents origination income, which typically goes to the broker who manages this pool. Then the broker also takes an asset management fee, which is a fixed percentage of the assets in the pool, consisting of cash, sometimes real estate, mortgages, and the like. And then lastly, what's left over is passed through to the private investor. That's what's been done, and there are many, many traditional mortgage pools in operation in California and elsewhere in the United States. The variations on traditional mortgage pool, one of them is a performance-based mortgage pool. Very similar to what we just saw, except instead of a mere pass-through of the income stream after payment to the broker of an asset management fee and the origination income, the broker takes a percentage of pool profits or interest over a preferred return to the investors. So it incentivizes the promoter or the broker who puts the pool together to exceed that benchmark standard and rate. Another one is a hedge fund mortgage pool. In a traditional mortgage pool, the broker bears nearly all of the expenses of the pool. The broker, don't forget, is getting the origination income, the points and the fees that are being generated on the loan. And so it's not only fair that the broker also pay the overhead associated with the pool, such as advertising, personnel expenses, insurance, etc. In a traditional mortgage pool, the only expense that it comes out of the interest or the investment income to the investors is the management fees to the manager, the broker, and the asset management fee, and the rest passes through. There may be some income tax and some LLC tax and some accounting fees, but very little else impacts the yield to the investors. Now, a hedge fund looks at the world a little bit different and says, well, what if the manager or the broker puts in all of the points and fees income into the pool and lets the pool pay all of its own overhead? And then that is usually coupled with a performance-based feature where the broker only gets compensated to the extent that the yield to the investors exceeds a preferred return. So they would take a split above that preferred return. This is how hedge funds are modeled on Wall Street. The second kind of pool that has become extremely popular of late is the buy and hold real estate pool. Now, the objective of this pool is to acquire rentals for cash flow and appreciation. There is the feeling that we are beginning a new real estate upcycle, and I believe that is borne out by the stock of the builders on Wall Street, by the results of Home Depot and Sherwin-Williams and other people who contribute to the construction process. All of those companies are up, their stock is up. Real estate values on the Case-Shiller index are up. we've bottomed out some time ago and we're on the rise. So there is the perception, and I believe an honest one, that property is undervalued and is going to undergo, hopefully, moderate appreciation over the next 5 to 7 years. So the objective of the buy and hold real estate pool is to acquire this real estate, hopefully at currently somewhat distressed prices. Operate the property for cash flow, modest cash flow, but positive cash flow, and eventually make a profit on the resale of the underlying assets when they appreciate over a 5 to 7 to 10 year time horizon. Now, the compensation in one of these is a little bit different. There's a lot of work done on the front end and the back end on each piece of real estate. The manager has to go out and find the real estate, negotiate the purchase price, do due diligence on the property, arrange the escrow, close it, a lot of work. And he may go through and look at many, many properties before selecting the one that's just right for the pool that he's putting together. So they typically charge acquisition and disposition fees. Then normally during the sort of coasting period after the pool has acquired real estate, there is a base asset management fee as a percentage of the assets in the pool. And either a third-party property manager is hired to manage the rentals, or the manager, if they're so licensed, does that as well. Some of these assets do require rehabilitation. Some of the properties are, somewhat beat up, and there's great value that can be achieved by improving them, cosmetic improvement. So the manager may organize that activity and charge a rehab supervision fee, which is normally computed as a percentage of the cost that goes into the rehab effort. The profits to the investors are, as you would expect, there's rents that come out of this pool as the tenants pay their rent. The expenses are paid, the leftover is distributed. It's probably not going to be at a barn burner rate, because that's not the short-term objective of this pool, is just to generate positive cash flow at any rate and not go negative. The real payday on this pool is when the assets have appreciated and are sold, and the typical pool will provide for some split and reward to the broker for success in making profits for the investors. A very popular investment device today. Now, the hold time on one of these is typically 5 to 7 years. Could be longer, could be shorter. Timing the market right is critical. The objective is either to pay all cash for these properties or a small mortgage. We really want to make sure that the properties positively cash flow. That is, that the rents exceed any kind of debt service on the property. Investing where we're using negative cash flow over encumbering properties doesn't make any sense, and is too risky in my viewpoint. So I won't do those. The advantage of the pool, because it has real estate assets that are improved, is that whatever income is generated, much of that is sheltered by depreciation deductions. Now you pick those up, you recapture some of that depreciation or all of it when the property is sold, but during the early years when there is a nominal return, most of that is tax sheltered, which can, even at 2 or 3%, if you receive that without the payment of income tax, far exceeds what you're going to get in a bank. And then you've got the upside of what's going to happen when you sell those assets in the future and reap the real profits. And which brings me to my other tax point, which is that this future appreciation is, unless our president and Congress start monkeying with the tax laws more, going to be treated at capital gains rates. Capital gains rates still went up recently a little bit, but still are much more favorable to ordinary income rates. So the early income during the holding period a lot of that is sheltered, and the eventual profits that come out of the pool are taxed at very favorable capital gains rates. So it's a win-win from that standpoint. Now, I've got some clients, maybe they're just cheap, I don't know. They say, well, Dennis, I want a pool that does both mortgages and invests in real estate. And I said, well, those are kind of inconsistent objectives. Our objective of a mortgage pool is to generate steady monthly or quarterly returns that far exceed what you would get in a bank or in other stocks and bonds. The typical mortgage pool today that I represent generates, on the average, between 7 and 9% return. Most of them are in the 8 to 9%. Some are lower, some are higher, some are over 10. So the objective of that is steady, boring, month-to-month cash flow. Where in a real estate pool, the cash flows are going to be much more modest because our real play is appreciation. So if you mix those two, you end up with something that probably no one is totally happy with, because the person looking for the cash flow yield is getting a low yield and maybe doesn't appreciate the appreciation potential, and the real estate investor is saying, why are we in the mortgage business? So client says, why don't we create a pool where we have two classes of investors? We've got one class here on the left side that's going to be our mortgage class, and one class of investor on the right-hand side that's going to be our asset class. And although the assets are all in the same pool, the same limited liability company, the performance of each investor is tied to these particular asset class. In one of these structures, the broker or promoter of the pool typically charges acquisition, property management, asset management fees, and any kind of rehab cost associated with the real estate side, and origination income on the mortgage side. And then the income then is divided between the two classes based upon the performance of that class. The good thing about this is that if an investor kind of wants to hedge or divide or diversify further, they can put some of the money in the real estate side of the pool and some in the mortgage cash flow side of the pool. So they can play cash flow on a monthly basis and appreciation on a long-term basis. So it gives them the ability to sort of gauge what they want and what they need and the risk they want to assume. Now, I think I covered this point. Investors can allocate funds between monthly cash flow and long-term appreciation strategy. That also gives you, the promoter of the pool, a marketing advantage. You can now offer two products essentially for the price of one. And they give the investor one consolidated statement that shows the performance of each of their investments. The investor's performance is tied to the assets that they invest in, nothing more, nothing less. Separate pools, I believe, are preferable, but combining the two does save cost and does allow you to market one brand and provide one consolidated statement to investors. Now, there is another way of skinning the cat, which I call the senior-junior class pool. Here and it could be either for real estate or for mortgages. The limited liability is set up with three classes of members. You have the manager, who is a member, and then you have a debt class or equity class, whatever you want to call them. It could either be a debt class where we issue promissory notes to that class, or we could say that their equity is preferred, that is, they are at less risk in the event of liquidation. They get their money first, like preferred stock, to a junior class of investor. So we create sort of two tranches in the investment scheme. We have a sort of a more conservative, less risk class that is either issued promissory notes or debt, or preferred equity that has a coupon return to it, and normally much lower rate of return. And then we have a normal class which is subordinated to the senior class. So this gives the person who really wants to minimize their risk the ability to be in the position where the entire junior class has to be wiped out from a capital standpoint before they suffer any hit. And their return is preferred. They get their principal plus their interest on their investment before anyone in the junior class gets theirs, either interest or principal. However, at the price they pay for that is a lower return. So with risk goes return, and the two are tied together. The subordinated class kind of says, I'm not worried about it. I think real estate is strong. I think the senior class are being little old ladies, so I'm more than happy to sit behind them. So that is, and predominantly in pools, I find that most people gravitate towards the subordinated class, that is the junior class. But I do think while the lower yielding or the senior class is safer, I think it's also good for weaker investors whose primary goal is capital preservation. If that's their primary goal, they're very senior in life, they are putting a lot of their assets into the pool, then their number one objective should be capital preservation rather than trying to get the highest return they can get. The classes normally, whether they're preferred equity at a particular coupon rate or debt at a mortgage or at an interest rate, is usually unsecured. We don't normally assign out mortgages to holders of a debt or preferred equity class. From the standpoint of the junior holder of this pool, they get a higher return, as does the broker, because of the lower cost of funds to the debt preferred class. In other words, the senior class is giving up some of their yield in order to induce the junior class to take on the additional risk. Now, the pool itself, well, any of these pools can be further levered with outside secured debt facility to further lower the cost of funds and boost yields to the equity class. In other words, you can conservatively, in the case of a real estate pool, go out and get 50% mortgages at 3-4%, 50% of the value of the property, provided the property still cash flows. And your cost of funds, if you mix everything together, you've got the money that is borrowed from the bank at today's low interest rates, plus the low interest rate paid to the senior class, really enhances the yields to the junior class. So that is the benefit of leverage, but not irresponsibly. We keep the leverage very modest and don't over-lever a property to the point where it negatively cash flows. So, well, I hope you enjoyed my presentation. As you can see, pools can be used for many, many purposes, and there's many variations on a pool. One thing common to all of them is that they follow the rule that you should never put all of your eggs in one basket. If you need help with forming a pool, whether it be for real estate or mortgage, you need to enlist a good lawyer, a good accountant, and know what you're doing. If you are thinking about investing in a pool, you need to check out the person operating the pool, their ethics, their disclosures, and make sure you're on board with the program. If I can be of assistance to you in either capacity, please let me know. Thank you, and I'll talk to you again.